Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for February 1st of 2026. Welcome to the beginning of the second month of the new year here in 2026. The big news last week was the Federal Reserve did not change interest rates. Not that the market was necessarily looking for a rate cut, but the consensus voted not unanimously, but voted to not lower interest rates. There were two dissenting members, Waller and Moran, that did want those rate cuts, but obviously it did not happen. You can see here the rate trajectory after the long and rather rapid rise in the tightening cycle. Here we're in this easing cycle. Rates were on hold for a long time and were held steady in this last meeting. So again, our current policy rate's about 3.75 at the short end, and this on the right-hand side gives us an indication of what the market believes in terms of rate cuts anticipated for 2026. And right now, that number's just around two cuts, and that would be two 25 basis point cuts, or about 0.5% over the balance of 2026. You can see here, if you go back to the fall, beginning of winter, that looked a little bit more like 3 to 3.5 cuts. And again, we're going to have to wait and see on this. I would think that from my perspective, there's maybe an argument that we get one more rate cut. I think two is a little bit optimistic based on what we see now. I think the big change in the calculus for the Fed is that when we were looking at some of these cuts right here, that the Fed was willing to cut rates in anticipation of inflation dropping. They basically cutting ahead of the further improvement in inflation. Now, I think where they are is that they need to see the actual data of inflation before they're willing to make additional rate cuts. So they're being a lot more cautious. Of course, that could change somewhat in May when Fed Chairman Powell concludes his term, and we already know that President Trump has nominated Kevin Warsh to replace him as Fed Chair. Again, that goes through the confirmation process. Don't anticipate there's going to be an issue there, but Warsh, depending on the snapshots in time where you look at some of the comments he's made, he comes across a little bit as a hawk and a dove, and so I do believe that his bias is going to be to reduce rates. So that is what's fueling a little bit of this two-cut number here versus what might otherwise be expected if Chairman Powell was still in office. Okay, a lot of discussion there. Let's talk about the Conference Board of Leading Economic Indicators. Those continue to trend down. We've got the recession periods marked in these shaded areas. Year over year, that has been relatively negative. Now, this used to be a tremendously valuable indicator, and I'm not saying that it's less so now, but I think we get a lot of questions about, like, hey, my business isn't doing so well, or I've got employees that don't feel as great as it seems like the economy is, and we've talked about the K-shaped economy, and so we have different things going on, and just to show this number as being perhaps weak or maybe in decline is really not doing it fully justice here. And so next slide here, we'll get into some of those determinants. So here we have the LEI index, and these are all the various components. And this is a chart from Charles Schwab and Liz Ann Saunders that shows you where the level is right now and what that trend is looking like. And you can see, red represents areas of concern. Work week, labor market, we know that that's been a little challenging. Building permits, we know from a construction standpoint, that's been weak. It is accelerating though. You've got labor market that's still a little troubled. You have payrolls, personal income, industrial production. All of these things actually are strong. In some cases, they're accelerating. Payrolls we know are decelerating, and consumer expectations for business conditions extraordinarily weak, but at least it's not getting any worse. So, and you've got credit. You've got interest rate spreads. You've got new orders and Institute for Supply Management, ISM new orders. Again, they're fair, they're not bad, but they're not great either. At least they're not decelerating. So you only have a couple of these elements on the LEI that are in abject deceleration. But, again, recognizing that for some people, the current environment feels a lot better than it does for other people. Other data we got last week, we got factory orders. I did not bother to show you the all-in number. I think it's more meaningful to show you the number that backs out the volatile transportation sector. You can see that that was up slightly after being down slightly in the prior reading. You can see here factory orders, again, excluding transportation. If you look out on a kind of a longer term horizon, let's just call it multi years, the bias is in a very weak sense trending higher, but it's not a especially strong move higher. I think you could almost argue that that's a little flat based on aggregate numbers, but it's not in decline. It's not super strong either. All right, balance of trade. We got to talk about trade because trade, the last time we looked at it, was actually a real positive thing. And it was influencing economic growth numbers to move higher. This is our balance of trade in the most recent reading in October. Well, excuse me, in November, it eroded again because we had a surge in imports, a little bit of a decline month over month in exports. And that's coming off a rather very strong month in October when imports were also down. And so you can see that month over month, this level of trade that we had, and it was far worse than the estimate, tracks a little bit of what we see here. And we're beginning to think that maybe this was an aberration. We had a lot of gold, ironically, gold exports that helped to fuel that export number. Now I'll slide over here, look at inventories, which is another component of economic growth. We did have a slight uptick in the last reading, and that follows a couple of months of additional upticks. And again, anytime you're building inventories, that can be inherently, it can be seasonal in some industries. It can certainly be cyclical. The thing is, you don't want to see a large acceleration of inventories because that tends to dampen economic growth in subsequent quarters when you're trying to work that inventory down. But I'd say this is a positive number. This not necessarily is a positive number, but again, this could have been a lot worse. And this is, the negative influence of people anticipating a tariff and trying to get out in front of it. So you could see imports ahead of the tariff were really, really strong. And again, this number here, in some respects, doesn't represent as much the tariff as it represents demand. So you can take imports as a positive signal. The lack of exports maybe is like a monthly aberration because of the surge in gold here, but then overall trade kind of getting back to where it was. Port of LA container volume is kind of important when you look at it from the perspective of trade with China and Asia overall. And I'd say especially China. You can see a seasonally adjusted container volume is down, and that's you can see like basically about 11%, 12% here. You can see the reported data is a bit noisier than the seasonally adjusted data, but just suffice it to say that container volume is down, but that's following a pretty solid uptrend over several years. Here we have the latest in the Atlanta Fed numbers. So this red here represents their estimate for the fourth quarter of 2025. And we were just talking literally a couple weeks ago about how that was tracking close to 5. In fact, 5.3, 5.4%. Now, given some of the more recent data, that's tracking a little bit north of 4%. Again, if you look at it against the backdrop of the last 4 or 5 quarters, it actually is going to shake out pretty well. But you just see how in some of these other quarterly iterations, how the landscape can change rather quickly, and as it has done here in this case as well. So again, Atlanta Fed now looking for slightly over 4%, which honestly, if it played out that way, that would be relatively strong growth in my opinion. We talked about capital spending last time. This is something that from Apollo that aggregates a lot of different things. We've got the CEO Outlook survey, and anything above 50 on that represents expansion. And we also have data from the regional Fed districts, and you can see that that is trending higher, which good positive sign in my opinion. A little bit more confidence in terms of the CEO surveys, which are certainly trending a little bit higher as of late. So relatively good news there. Daily jobs postings, again, the labor market a little bit sluggish. We see this long-term trend line down over the last several years with a little bit of pickup. Again, not necessarily breaking that overall trend line. And latest readings there were a little bit of a tick down. So just evidence of a labor economy that's just kind of in a gradual slowing mode right now. Same store retail sales, you can see here relatively flat. We've been talking about this for a while, but they're flat at a little bit more of an elevated pace. You can see going back here into a recession, oftentimes, again, this is just one very, and albeit very brief recession, but oftentimes you see some complacency or some kind of like stagnation in the data heading into a recession. Then obviously the recession causes incomes and consumers to pull back and so on and so forth. And you see that, and then you see the rebuild again. But again, latest data, rather unremarkable, but in a very positive way. Michigan consumer sentiment, we've talked about this a lot. The sentiment indicators here, again, we're talking about soft data like surveys and sentiment as opposed to hard data, which is factory orders and things like that. This has languished for a while, and we do know that this particular survey tends to emphasize people's thoughts and expectations with regard to inflation. And when we had large, inflation in 21-22, we could see that that was rather weak. But ironically, here we are in 2026, and we're at levels that are kind of mimicking that period. So sentiment, as defined by the Michigan index here, is still very, very weak. We break that up into current conditions. That's particularly weak. And the silver lining would be if we saw expectations improve, and in fact, we actually have not seen that improve. So this particular reading, this soft data reading, is emblematic of, I think, a demographic that is predominantly, or I guess is more predisposed to impacts from inflation at the supermarket, and and tends to perhaps focus on lower income cohorts that are struggling more than the upper income ones are right now. Here we have inflation expectations. So we've got the 1 year data here, 4%. That's in the black line. So 1 year inflation expected to be 4%. Please note that that is actually higher than where inflation is now. So this survey is expecting, the respondents are expecting inflation to move higher. 5 year estimate is about 3.3. Again, that's also above the Fed's target. So I think, and you could see that the upward trajectory of this. You go before the pandemic, and they were pretty well anchored at about 2.5, and so to see 3.3 here is not necessarily disconcerting. I think it's just telling us that there's broad expectation that that we're not going to be able to completely reach the Fed's mandate of 2%. And honestly, if you go back to 50 years preceding kind of like 2010, then that 3% was pretty much the norm, and that's what you used in financial planning calculations. That's what you used in in deflator type situations and other inflation expectation numbers. So these numbers don't surprise me, and kind of like switching gears and looking at I guess the consumption landscape. We talked about how consumers and retail sales are just kind of plodding along, looking for larger refunds this year because of the OBBBA, the Big Beautiful Bill Act. And you can see that follows a couple of years of some modest increases here. These are average refund sizes, so you'd expect that there'd be some inflation tied to it, but oddly enough, you go back to many years and that really hasn't been the case. But this year is supposed to be a bumper crop because of that law. A little bit of a noisy chart here, but I find it particularly interesting. This is Federal Reserve policy since the financial crisis, and here's in the black line you can see the policy rates. We just talked about the easing cycle after the rapid tightening cycle. But what this also overlays is the other things that the Fed's doing. So you've heard quantitative easing, where basically the Fed is buying assets, buying treasuries, mortgage bonds, so on and so forth, uh, from the market. They're going into these are called open market operations, and so they're buying these in the open market. So they're injecting liquidity because when they buy them, they compensate the seller with cash, and then that gets cash into the system. And so we did that for a long time to help grease the economy while we kept interest rates at or near zero. And you can see in the pandemic, we kind of like blew out the sides of the barn there with these asset purchases at the same time the interest rates were low. And then we saw a little bit of a sea change here as those asset purchases declined, but they declined at a lower rate and at a higher overall level at a time where we began to ease. And now we're just now beginning to see the signs of some resumption of those asset purchases. So again, Federal Reserve monetary policy is very, very interesting, but this chart is here to emphasize to you that how the Fed influences interest rates is not just by the policy rate. They're doing a lot of these open market activities as well, and that's very influential on the money supply, which you've heard me talk about quite a bit as well. We'll switch and talk about housing for just a second. Something that really stuck out to me in this chart is just the wide gap between where sellers and buyers are. And we've talked about affordability, and we've talked about the dislocations in this market and the struggles that new build home builders are really struggling with. And I think this is very emblematic of that gap. So what happens from here is that you can look back here and go to 2013, and when you have these like dislocations, I mean they tend to even out over time, and I do think that that's going to be the case here. I think the implications are that we're going to see some softness in home prices, and that the buyer interest is going to be weak for a while because this is also, of course, influenced by mortgage rates, which we know have been obviously higher than they were 5 years ago. And I think there is the complacency setting in now that those rates are going to be higher for longer, even if we see a little bit of some of those rates come down just a little bit over the next 6 to 9 months. Interesting chart here. We've got multifamily rents that have now eclipsed single family in terms of the percentages. And so, again, policy implications at the municipal level with this. Obviously, you've got a lot of debate over affordability and long-term rentals at the residential side. You can see that single family not too long ago was well north of 35%. Now it's 31%, so this is the lowest that we've seen that. And then consequently, rentals and multifamily do in some measure because of the additional construction that we had kind of coming out of the pandemic on multifamily. You can see how those two areas have turned around considerably. Very interesting data here. This is Fred. So this is the St. Louis Fed's database, if you will. And so this is basically taking housing inventory or housing units and dividing them by the population. And so, we've been listening to how there's a dearth of supply and that we underbuilt for many, many years. Well, that's very true in single family, but not so much in multifamily. And we talked about this in the last chart that we had a lot of multifamily construction over the last 5 years. And when you actually look at the data and you say, let's just look at everything as a housing unit, whether it's an apartment or whether it's a single family house or townhouse or whatever, that if you look at it on a per capita basis, actually our housing stock is moving higher. And so the issue that we have in housing right now is actually not supply, although granted, there's people out there that are definitely wanting to buy. They don't want to rent and they don't want to live in an apartment, or they have a family and they can't. But if you look at it strictly as a housing unit, as a percent of the population, we're actually moving higher. Here we have some data that kind of confirms a little bit of what we've been talking about. You can see price declines from a lot of different measures here, whether it's Zillow, Case-Shiller, Freddie Mac, and so on and so forth, FHFA. They're all moving lower. And honestly, I could see here in the coming months that those actually turn negative for some of the reasons that we've just been talking about. Very interesting chart here, and it goes back to the year 2000. And I think we all can, pretty much agree that there are parts of our lives that have gotten a lot more expensive. And this is from the Bureau of Labor Statistics, so these are government stats. But some of the areas that you would think, technology, cell phone services, computer software, those TVs, especially, to get a 75, 80-inch flat panel TV versus what you would have paid, even 5 to 7 years ago is ridiculously low. You see toys, clothing, some of these new cars, importantly, have gotten a little bit cheaper. And they remain kind of below their levels. Well, these in particular, we've seen outright deflation. Here we've seen kind of more benign inflation. And then you look at overall inflation, and this is not annualized, so this is aggregate price levels. But look up here, hospital services, very, very strong inflation. College, childcare, medical services, you see average hourly wages that have exceeded overall inflation. That has allowed the consumer to spend because real wages are positive. And then, of course, housing we've been talking about quite a bit and also talked about in the last slide. And then food and beverage, whether it's at home or whether it's food away from home, has gone up in a pretty meaningful way. Productivity. This is what helps to keep inflation low when you have strong productivity. And we actually do have reasonable productivity right now. And this chart from Apollo kind of goes through some historical backdrops. Again, these shaded bars are recessions. So we had the PC adoption phase really extending from 1985. That was a big part of my life. And then obviously the internet, which is a big part of more of our lives as our children were getting older. And you can see that that did have a meaningful impact on factor productivity. And then productivity was positive, but it went down over time because we just didn't have the next best, the next new thing out there, which we now do, and it's AI. And we're just now beginning to see that manifest from the promise of AI to being embedded in core applications and having an impact on the demand for labor. So this will be very interesting to watch how this plays out. But this is one of the reasons why, if you are a dove when it comes to interest rates, you're advocating for lower interest rates. you're convincing yourself that, hey, we're going to have productivity that's going to help keep inflation low and provide more cover for us to drop interest rates. So we talk about employment and being a bit sluggish. This is a chart that I think helps to delineate where that's where that sluggishness is coming from, and you can see the cumulative change in employment since the beginning of 2024. So call it really 2 years. In the smaller company category, you've actually had a lot of erosion there. I mean, small companies kind of keeping things close to their vest, being a little bit more conservative on spending, trying to be more sustainable. I give some a lot more credit than I give other small businesses, but suffice it to say, where we've had most of the I call it erosion in employment has been at the small company level, whereas you talk about the mid-level companies and certainly the large companies, and you still see them expanding by and large. So inflation, we've talked about the regional Fed data a lot, and there are some puts and takes, and so this brings us in front of the Philly Fed, New York Fed, Kansas Fed, Kansas City Fed, and then the Dallas Fed, and these are all prices paid. And when I've been showing you the regional data, I've just been focusing on orders, but within each of these surveys, they actually survey for prices paid. And you can see that all of these are being led by 6 months. And in the green line, this represents personal consumption expenditures, PCE, which is, again, the Fed's preferred gauge of inflation. We've been talking about how that's sticky, kind of at or near 3%. But then if you lead all these other regional indicators for prices paid, again, these are producer prices that eventually when they hit the consumer, what this is suggesting here is that inflation is going to move higher because of these prices paid being elevated. So again, that goes against what we just looked at in the productivity sphere, thinking, well, increased productivity will help keep inflation lower. But if the actual observations are that producers are paying higher prices, then that, ideally, because of the correlation here, should lead to a higher overall PCE, which obviously would be higher, would represent higher inflation. Okay, here we've got the dollar. We know dollar has been weak for a period of time and remains weak. Means our exports are cheaper to the rest of the world and means that our imports are more expensive. Natural gas futures, not too surprisingly, have shot up in the wake of the cold weather that we've seen. Very sensitive to that, to weather patterns, especially during the months that are in between the shoulder seasons. Here we have precious metals, and we had several meetings last week in which the topic of gold and silver came up, and there's really no better way to explain it than there's speculation, there's a flight to quality. When there's policy uncertainty, you tend to gravitate towards gold. I'd argue silver had much more of an elevated increase than gold did. However, when you have these kind of movements, it is important to note that you can also have rapid change on the other side too. And we saw a significant sell-off last week in some of these metals, and some of it was maybe the feeling that the new incoming Fed chair is going to be more hawkish. It's going to slow the economy down. There's just a lot of things that kind of played into this. But I think kind of putting it in layman's terms, I think these metals just flat got ahead of themselves from a price to value standpoint. So another thing that I've been watching, and we've been talking about too, is this flight of money into money market mutual funds and this accumulation of net liquidity which could be used for acquiring risky assets like stocks, like real estate, so on and so forth. And very interesting, we have the Fed is now cutting interest rates, so you're actually earning less. And we've talked to a lot of clients now about the effort to try to find some high yield savings. We don't have 5% short term rates anymore, and so honestly, I did think that that would result in a tempering of this growth trend, but it in fact has not. And we see, we're almost, close to $8 trillion of net liquidity being harbored in the market. And you can see how, going back to the pandemic, that has absolutely accelerated after, a whole decade of it remaining relatively flat. So it's a lot of dry powder on this. So Fed starts hiking. Obviously, people are moving into it because they want to avail themselves to higher interest rates. But when they start cutting rates, that hasn't changed the issue. Something I always enjoy showing is this histogram of S&P 500 returns. Right here, you can see the preponderance of observation falls within kind of a negative 10 to 25% range. And so if you take kind of the soft or the weighted average of that, then that falls into, somewhere around, call it about 10% if you reinvest dividends. And you can see that, generally speaking, when you have bad years, you don't necessarily follow them up with another bad year. In fact, the rule of thumb is that you have a bad year and the next year is actually a little bit better. But we think about I think about this a lot when we're doing structured investments and we're capturing or we're in putting into place like downside hedging for at least a part of one's portfolio, where over a 3 to 5 year period, the market is very unlikely. You can see that all these are different dates from different times. Very unlikely for the market to go down 20, 30% over a 3 to 5 year period. It's just very rare. But the law of averages here is actually pretty compelling. Earnings season, not so great so far. You can see here this data from Bloomberg. A little bit of a step back here. We've had quite a few quarters of positive surprises. Not so, it's not to say that earnings are just abjectly poor. They're just saying we just haven't had the surprises that we usually do. And you can see that the percent of positive surprises has certainly gone the other way. Bull and bear indicator. This is just more confirmation of what we talked about last week. It's very optimistic. This would, by B of A's, by their global investment strategies definition, be the kind of the demarcation of where you'd have extreme bullishness, and we are absolutely there. And again, very optimistic now. Fund managers hold very little cash. They have done relatively little hedging. Everyone's pretty complacent right now, and I think that's a good sign for us to be guarded and eyes wide open for potential volatility. This is very interesting because this is reflective of the global environment. We know that the international markets have done very well over the last 6 to 9 months. This represents the percent of global equity markets that reached their all-time highs really within the last 30, 45 days. And you can see that number has really spiked higher. And you've got to go all the way back to 2005, 6, 7, right before the global financial crisis to see some of the same levels that we see right now. So again, optimism is not just a function of what's going on here in the U.S. We do have a lot of data on this slide, but I thought it was very important to put on here because just looking at the headline, you've got periods of strong earnings, which we have, and relatively strong GDP or economic growth, which we have. And honestly, when you look at above above average, call it economic growth and earnings growth, you tend to have some of the worst returns of any combination of that. And the best combination, ironically, is to have slightly below average GDP growth and then stronger earnings growth. And so, that's where you get the best returns. It's almost like, calling it, 2.5x here. So, history is a guide. It's not the absolute. These things help to inform our thinking on how we need to prepare portfolios and things like that. And again, when you have anything that's below normal, or in this case, nominal, like below average nominal growth, you tend to introduce more volatility, and that for us allows us to do more things with regard to hedging and structured investments and whatnot. But I just threw this up here because it is a little bit counterintuitive to think that if you're hitting on all cylinders, that you tend to have a little bit lower performance, because in some cases, that expectation is already priced into the market. Contribution to earnings growth as it stands right now, and we have a lot of expectations built into technology, financials, communication services, and the industrial infrastructure trade. Lesser degree, we've got some of the other sectors here, but clearly technology is driving the boat when it comes to expectations for 2026. We have valuation conversation. This is not surprising at all. This is data from Goldman that we have the S&P 500 at 22 times forward price to earnings. And then you've got the equal weight, which, as we saw last week, is performing better against the overall index, still at 17 times. So not overly stretched as the cap weighted S&P 500 is at this juncture. And here we have the estimated forecast for earnings growth as well. So again, coming off 2025, we had call it for the SPW is the equal weight, SPX is the cap weighted. You can see that there's very strong expectations for the cap weighted growth over the next couple of years. And as we just saw in the last slide, a lot of that is expected to come from technology. But what's interesting here too is that we're seeing almost a greater acceleration over a 2-year period in the earnings contributions from the equal weight. And I think that's important because we are seeing more breadth across the markets in terms of how they're acting and reacting to things. Again, but there's still a concentration of the high flying tech firms, and I think anytime when you're building expectations to the magnitude that they are, that there's a lot riding on that. You're kind of pricing to perfection, and so time will only tell if these numbers are going to prove accurate. But if you did get 15% earnings growth, that would be historically very strong. Tech sector, forward PE, we've talked about tech's contributions to earnings, really got no valuation expansion this year. So earnings were strong, and so earnings helped to propel overall prices for those technology firms. They just didn't get the multiple expansion last year. Very interesting chart here that we have talked about a little bit in the past, where you look at household wealth and where does it accumulate. We used to always talk about, like 20, 30 years ago, how it was really embedded in the house because you didn't have as many people invested in the stock market as you certainly do now, and you certainly don't have like the amount of concentrated wealth that you have all across the population spectrum. But you can see an increasing portion of U.S. household wealth is now held in the stock market, to the point of, it's almost half of their wealth. And you think about how housing prices have moved higher for those who own homes. This is a pretty profound statement when you're tracking basically, we'll call it roughly speaking 2005, but we'll kind of mark it at the low point of the global financial crisis and say in call it 16 or call it 17, 18 years, you've gone from essentially 20 to let's call it 45% as a percent of their total net worth. So very, very profound change there. Here we have the intra-year drawdowns, and I've shown this to you a lot. First Trust actually does some great work in this area too, but it's all the same data. You just see all these little red dots represent kind of like the max drawdown point within the year. And I think what's really telling here, and what should be your takeaway as a listener, is how often you see these, right? I mean, these red dots, and some of these are like, negative 15, 20% or more, right? And if you get into a bad year, the blue bars represent the annual return for the year as it ends up. And so it's, again, just to remind everybody, it's not uncommon at all to see years in which, at some point in the year, you're negative to a pretty fair amount, but then you wind up being, positive, and in some cases, like remarkably positive for the year. So, again, intra-year corrections of like say 2%, you tend to get three of those a year. The 5% corrections, maybe you get one a year, and then 10 to 20%, maybe you get, anywhere between 1 and 3 years. So, I mean, it's very normal to have that. And again, unless you're dealing with like a considerably poor and like an abjectly poor macro environment like we were in 2008, your max drawdown was 50%, but you still ended the year down 37%. Unless you're in that kind of environment, then oftentimes you get these kind of these downturns, but you wind up very much positive for the year. Here we have insider selling, something else that I'd say raises some eyebrows a little bit. When insiders are selling, that tends to be a bit of a contrarian indicator. Again, we haven't seen insider selling this high for a period of quarters now. And again, just something you want to watch. Insiders sell for a lot of different reasons, not just to try to time the market and for investment purposes. Oftentimes it's because they're trying to exercise, and they're having to sell the stock to pay the taxes on the grant. So in any case, they're a little bit higher, and that bears watching. Now we've got some investors in kind of non-traditional or alternative assets and some of their buying intentions. As we look into 2026, interestingly enough, we have perhaps an increasing number of folks looking at hedge funds and to a lesser degree private equity. I'm not going to say that these numbers necessarily changed a lot from the prior year, because a lot of people are invested and they're just saying, hey, I'm not going to change my exposure. Venture cap maybe saw an uptick in those saying that they were going to reduce their exposure, but then these other categories will remain reasonably constant, with private credit still being very much in vogue, and this would be decrease in exposure. So this has remained fairly constant for a while, but again, big positive net flows are likely to be seen in private equity and hedge funds. We have more corporate bonds coming, so we clearly have had a multi-year ramp in issuance, and this actually coincides with rising interest rates. So a little bit ironic there, but we're seeing very big issuance this year. Some of these are refinancings, but in any case, the supply of fixed income product is only going higher. Interestingly enough, too, again, we talked about this on the equity side, but on the fixed income side, that demand by foreign buyers in U.S. debt remains very, very strong. In fact, maybe even acceleration. So that's helping demand to keep basically prices higher and maybe yields a little bit lower. And then, as we were just talking about, investment grade bond sales are set to set a record. So you can see here represented a little bit differently. This is more, treasuries as opposed to more corporate credit in the prior slide. But in either case, we're getting a lot more supply in the market this year. So something that I think it really is going to bear watching, because we know that the cost of the federal debt outstanding is over $1 trillion. In fact, we pay more in interest on our treasuries than we do on our military. And that was something that happened, that inflection point happened a couple of years ago. You can see that, basically we've got about a third of all Treasury debt outstanding is going to mature over the next year. We've been doing a lot of issuance of short-term paper, trying to keep those debt service costs a little bit lower. But again, I think what that's going to do is it's going to, essentially raise the overall cost of that debt for the federal government at a time where they're, carrying sizable deficits and having to issue more and more treasuries. Population growth, the last two charts are really more for kind of like personal interest, and this has longer term implications. We talk about birth rates and population replacements, and the yardstick has usually been that you need 2.1 children per household to at least keep your population base stable. We know that population growth has declined, not just because of the birth rate, but I think especially due to immigration. And to the extent that that immigration spigot it really is curtailed or turned off, it's going to keep that number low, and it's going to have longer term policy implications down the road. Now, if you have low birth rates and you don't allow immigration for, again, let's call it 5 to 7 years, if it becomes a lot more systemic, then you run the risk of, not being able to really dig yourself out of it for basically a decade or two, and it becomes more institutionalized, and you have a whole generation of people that is, generation of potential labor pool entrants that is lower than what you need to deal with an expanding economy. Last one here is kind of a net migration within the U.S. Analysis, and this is obviously we live in the South, and probably more accurately the kind of the South, mid-Southwest part of the country, and we like to talk about how much we get people moving here from other states. And that was certainly the case both before and leading up to and after the pandemic. But that's actually gone back down. So, they're not necessarily staying put. They're just going to different areas. And some of this is a result of housing affordability and some of the house pricing that we've seen. Access to jobs is relatively plentiful, so it's not necessarily that, but probably has more to do with housing than anything else. Hope you've enjoyed the chart pack this week. Have a great week, and we'll talk to you again soon.